In 2022, inflation forced central banks into the fastest pace of interest rate hikes seen in decades, leading to negative returns for both stocks and bonds simultaneously. As three major peaks eventually materialize, peak inflation, peak rates, and peak valuations, a more sustainable recovery in most major asset classes will ensue. In 2023, much is dependent on the path of inflation, rates, and the resulting economic growth. The world is transitioning from an inflationary period to a slow growth or even recessionary period. Investors will need to be nimble to appropriately respond to developing market conditions. Policy changes influence economies with long and variable legs, so inflation data coming out now doesn't reflect all central bank efforts to rein in inflation. Improvements in supply chain dynamics are helping to ease global inflationary pressures, but excess demand in the United States and the continuation of geopolitical tensions overseas leaves inflation above target. There are signs we are near peak inflation, as aggressive rate hikes are slowing economic growth, which will eventually lead to looser labor markets and demand will weaken. The last leg of the climb could be less strenuous if diminishing geopolitical tensions and lower commodity prices accelerate the disinflationary process. But it's important to remember that headline inflation, which includes the more volatile components of food and energy, tends to plunge, while core inflation, which excludes these volatile components, has historically eased over time. The global economy hasn't seen rapid policy tightening of this magnitude in over 40 years. As inflation remains above target and economic growth continues to slow, the risk of a policy mistake will contribute to market volatility. But currently, slower growth and inflation suggests markets are approaching the final stage of this rate hiking cycle. In the near term, bad news for the economy could become good news for the market, as this will signify we are near peak interest rates. Incoming data that reinforces slower growth and inflation without a hard economic landing would stabilize rates, and the ascent from here would be clearer. The last steps of the climb would certainly become more treacherous if inflation remains stubbornly high due to persistent demand, forcing central bankers to tighten further. Given much higher interest rates, bonds now offer an attractive coupon, which may invite competition for demand with equities. Equity valuations have also improved, and global stocks are poised to generate above-average returns once a sustainable recovery emerges. Initially, the ascent towards peak valuations could appear smooth if softer economic data exerts downward pressure on rates, supporting higher prices for stocks and bonds absent expectations for a hard economic landing. But before we reach peak valuations, we must assess the impact of slower economic growth on corporate earnings. As we finally reach the peak, rate differentials between countries will eventually decline, boosting international equity returns for U.S.-based investors as the dollar weakens. There are many ways to descend from the mountain. Some routes could be dangerous, presenting some challenging conditions, but there are potential routes that could be much easier. The most difficult descent would occur if inflation stayed higher for longer, forcing central banks to increase rates more than currently anticipated, leaving the economy at risk of a deep recession. This would be a painful descent for equity investors, as valuations would be pushed even lower, but a severe recession would ultimately lead to lower interest rates, and bonds would provide positive returns, making this route a successful but painful descent. A less challenging route would entail a shallow recession with easing inflationary pressures, which allow central banks to stay on course, lessening uncertainty for the markets. The shallow recession would cause lower interest rates, improving bond returns, and providing a floor for the stock market. The ideal route is created by central bankers delivering a soft economic landing with no recession, thanks to moderating inflation and precisely the right amount of monetary policy. There is minimal impact on earnings in this route. helping equity valuations, and bond prices would rise as rates passed their peak. We anticipate that further advances in the stock market will likely be volatile in the early part of 2023 as the economy continues to slow and the earnings outlook deteriorates. The stock market isn't expensive at today's levels, and we must remind ourselves that today's market backdrop does resemble the conditions that occurred in the 1970s. During this period in history, the stock market began to recover once rates started to fall, even though an earnings recession ensued, because investors began to anticipate a better economy ahead. These two factors lead us to a neutral position within global stocks, but we will add exposure to target U.S. companies with strong cash flows and healthy balance sheets to weather the imminent decline in earnings. After a brutal year for the bond market, there is now income in fixed income. Yields are now at the most attractive levels seen since the global financial crisis. Going forward, bond returns look skewed more towards the upside than the downside, so we will enter the new year underweight cash and overweight fixed income. Yields could rise if inflation surprises further to the upside, but the current coupon of over 4% offers a decent offset to any near-term pressure on rates. Additionally, U.S. and international bonds provide a valuable hedge in a recessionary scenario. If rates fell 1% in the U.S., the total return for bonds would be approximately 10%. If rates fell more than 1%, the return would be even higher. Within alternative beta, we continue to emphasize the asset class's ability to dampen risk and are positioning to hedge against a potential challenging descent from the peaks. APCM will emphasize strategies with the lowest correlation to stocks and bonds that also provide the opportunity for positive returns in a wide variety of financial market environments. At the same time, the strategies that are most strongly tied to the equity markets will not be held while volatility remains elevated. Your team at APCM will be here to guide you through the rest of this climb. We enter 2023 prepared for slower economic growth, but we anticipate a nimble approach will be necessary as we manage this transition from an inflationary to a recessionary environment. We may have to alter our route as incoming data helps us finish this climb, but we are well equipped with diverse portfolio holdings designed to provide adequate support as the peaks emerge and the descent path becomes clearer.